Good morning. Today is Thursday, October 20th. I like the shirt, Tom. That was a Austin pickup, right?
Triple Z threads, cowboy shirts. And also they sell marijuana now, which we discovered when we were there, which is still not legal there, but apparently you can buy it.
That was a very odd interaction between myself and the customer.
Between
just
Ben
wandering
and
around,
each slinging weed at the counter.
That was very odd. Oil. We're going to start right there. President Biden unveiled his oil strategy yesterday, and SPR releases we've been talking about is three-pronged: SPR releases, SPR replenishment, and calling on companies to lower refining margins. So number one, number three, we've talked about ad nauseum in terms of SPR releases, potentially to the ability to do more in the winter if needed, and also saying that some refiners are over earning. But the SPR replenishment, we really haven't talked a lot about. We talked about it briefly yesterday in terms of being able to repurchase crude oil when prices are at or below $67 to $72 a barrel. And they can use futures. I think what probably we haven't talked about enough is, could this actually provide an incentive to produce more? Is this the coup de grace from the Biden administration? Because actually, if his goal is to provide an incentive for increased domestic oil production, this is it. Admittedly, maybe you could reduce some of the regulations, et cetera, but he's basically given oil companies a price certain in the future, and they can operate with that reality. They don't have to be nervous about oil prices collapsing to $40 again.
Yeah, the question is, by the time they get it up and running, is Biden still going to be in office? You know what I mean? It's like he could be promising that, but the question is, does that promise hold up? I mean, I get your point, which is that, you know, they can basically get the green light and say, hey, if we're profitable at, call it $60 a barrel, we know we're going to get $67 to $72 in the future, then we might as well start producing or exploring some of those leases, or at least trying to get some. There aren't very many. There's a lot of confusion about actually how many leases are available to drill. But I would say that, you know, it could cut both ways in the sense that, you know, it's probably going to have a lot of upward pressure right now on prices, because they know that for sure there's a buyer waiting, and if they never get to that price, they can sell higher than that. But yeah, to your point, on the flip side, if they know that that can be replenished and that's going to be the price, then they know they have at least some certainty in terms of price going forward.
You saw it have a big impact on the oil companies yesterday. Oil companies, but especially oil field services or capital equipment providers, performed very well, and that those companies are again leading this morning. So that'll be something to continue to watch. And it did really spark a bit of an inflationary day yesterday. We saw interest rates go up. We had the inflation data from the UK pre-market, but between the oil going higher, and we're seeing the follow through today, and interest rates going higher, it seems like this inflationary reality is continuing. Procter & Gamble, like we talked about yesterday too, accelerating pricing. So that's really interesting. And Jim Bullard has already talked about another triple rate hike in December, which we've talked about a lot, but now it's quickly becoming consensus.
I mean, it's not only is it priced in, but the odds are continuously ticking towards a full percent. And that, you know, the 6 rate hikes that we've talked about, I mean, that one's basically consistently ticking towards a certainty as well. We're looking at 5.8. That's up from 5.12 2 weeks ago and 5.6 earlier this week. So we're basically marching towards 6 hikes. If you look at futures, we're probably 8 total sometime in the next 5 months, which is still higher than I think anyone anticipated. I mean, that'll put us at, 25 hikes or so in the first year. And I don't know with certainty that that's going to be the end of it. You know, kind of all along the way, we've been behind the curve in terms of how many hikes are really coming. So we'll see what that looks like. You know, I'm sort of locked in at 3. I don't think they'll do a full point unless something drastic happens in the next month or so. And then, you know, we're looking at another, 2, probably maybe 3.
And it creates a lot of interesting dynamics in the portfolio management perspective. Some that we have talked about in terms of, you can now lock in 5%, coupons basically, and yields on bonds with essentially zero credit risk. And then if you want a municipal bond, you can, and talk about the tax equivalents there, talking 7-8%. So, you're starting to generate some serious yields on some of these instruments. Admittedly, it's not where inflation is, but it's a lot better than it used to be, and it certainly is a lot more competitive than it used to be as well. So that's something that we continue to watch within portfolios. Anything to add there, Tom?
Yeah, just in terms of getting creative, even with cash flows, there may be opportunities where we know we need cash at a certain date, but we know that the market is up today. We can do something that may throw the allocation off for a short period of time, which is sell stocks on up days and rotate immediately into short-term treasuries that we know will mature before that cash need is on the table, where you can basically say, hey, we're going to lock in here. The market could go up or down, but we know that for sure we're locking in for, say, another 3% annualized for a month. That cash turns, that bond turns to cash, it flows out to the client. So those things are things that were never available before. And, we can kind of get a little creative in that. The allocations could get a little funky, on an intraday basis. But the idea being that if we're going to be in cash or raising cash, we need to be using that as short-term instruments to make more money while we wait for that cash to leave the account or to be deployed in other places. And so, that's where, putting in money markets, using short-term instruments, getting creative with selling on updates and buying treasuries, then rotating back at a later date. Those are the things we're trying to work into this market now, because it's gotten so dislocated in terms of where the rates are on the very, very short end.
Internally, what we're doing is we're leaning into this too. We're putting a little bit more research into it, turning over a few more rocks, but we're also have just signed the paperwork, I think, to add this thing called Bond Wave, which will give us a better holistic view, even than we already had, in terms of looking at where portfolios are positioned and actively managing that fixed income portion to maximize that yield, because right now there's a lot of opportunity in that space. And so we're leaning into that. We'll probably have more to say on that, but if you're a client, probably within the next 3 to 6 months, we'll have a little bit more in-depth reports that we can go over with you to the extent that you're interested. Switching gears to individual company news, Philip Morris, which actually reports earnings this morning as well, and we'll talk a little bit about that later. But they're doing deals right now. They're looking at this environment and they're trying to make deals happen. The one that we've talked about here is they have this offering to purchase Swedish Match, which is the maker of Zyn and which is Swedish snus. They had originally came out with an offer of 106 Swedish krona. They've hiked that offer now to 116 krona. The board of Swedish Match approved the deal, but they have an activist investor in the company who wants more money out of Philip Morris. The clever thing here, though, for Philip Morris is that even though they are paying more in the local currency, the headline price in US dollars will actually be lower. So because the krona has depreciated so much against the US dollar, Philip Morris is actually getting a discount, even though on the surface it looks like they're increasing the price by 10%. They're separately also negotiated a deal with Altria to market their IQOS system in the US, which is a heat not burn cigarette or tobacco instrument. They've negotiated that deal for $2.7 billion. They'll have exclusive rights to commercialize that as of April 30th, 2024. $1 billion has already been repaid. The remaining 1.7 will be paid by July 2023. I think it's a good deal from Philip Morris as well. They came up with the technology, and the thinking was always that Altria and Philip Morris would merge back together. But given the nature of the antitrust right now, that's just not going to happen. And Philip Morris wants the economics of this. Altria wants the money. So it makes sense from both sides.
Yeah. I mean, the IQOS has had almost no traction here, but it seems to be picking up quite a bit overseas, which is primarily where Philip Morris operates. And so that's a good move for them. And then the Swedish Match deal, I mean, I think this is the way out for them to get out from underneath cigarettes long term. I mean, Zyn is a super popular product. Shout out to me for quitting effectively. It was very, very popular during the lockdowns, and when you're sitting around just looking at the markets all day, nicotine can be a real stimulant. So, it got my hooks in me, but it's a popular product, particularly around young men around my age, in their 20s, early 20s, just out of college like myself. So I think it's the way forward. And I know a couple people who have successfully quit smoking from it too. So I think it's significantly better for you. Is it good for you? I don't know, but it's definitely a profitable product, and I think they're going to do well with it.
Philip Morris, for its part on earnings, they actually cut their guidance for the year. That was mainly because of supply chain disruptions on IQOS, but cigarette volume is actually performing quite well. So that's something to watch going forward. Their stock's up 2% pre-market. The big earnings from last night was IBM, where they talked about demand is quite robust everywhere except Europe. They say in the Americas, I find a very robust business environment. Asia, it's very similar. They do say that in Europe, I think we shouldn't put our head in the sand. There's some caution creeping into the conversation, albeit not in the data. But there could be a bit of a downturn in Europe only. So IBM pretty sanguine in terms of the technology spend internationally. You also had Tesla, which was the big one last night, reporting earnings. Their stock's down almost 6% pre-market. Couple reasons for that, but primarily it seems like demand is a little harder to come by in this market. Tom, what are your thoughts on Tesla? It seems like they're trying to excuse away some of these demand headwinds. And they basically say that they have extremely low market share even now, and they have a lot of headroom, and they're very confident long-term. But the numbers aren't really saying that as clearly as maybe they were 6 months ago.
Yeah, I think they're kind of returning to reality. I mean, the stock has always been a hype stock. The future, it's going to grow and grow and grow. But I think they're the low-hanging fruit in terms of people who can dish out, the cost to buy a Tesla and are willing to make that leap. I think that low-hanging fruit's probably, for the most part, already harvested. And so now they've kind of got to get into that second level where they're getting into the market, gaining market share away from other cars, which I think is going to be tough. I mean, they're typically at a higher price point. There's a lot more upkeep in terms of having to install the charger. There are other electric options out there that are much cheaper or probably more approachable for the average person. They do, no one considers buying a car based on what Jim Farley, the CEO of Ford, is doing, but some people probably make that choice based on what Elon Musk is doing. I mean, he's a controversial character, and I think that probably lends itself to the business as well. So I think they've got a lot of headwinds and a very high valuation historically. That being said, I mean, we've looked at Tesla recently. The fundamentals are very clear that, it is a company that makes money, and there's a lot of good things there. The question is, at what price do you start to filter in there? And I think we're getting closer, but I don't know if we're necessarily there yet. But I think that, you add in some of the things like the solar roof and the power walls and all these things that are a little more forward thinking and a little less visible compared to the cars. And I think there's a lot of legs there, but I think it's just a long-term story, and evaluation is key.
One other anecdote from Tesla is that I know we've had some questions on how the stock buyback tax coming in next year, the 1% tax on buybacks, will impact share repurchases, but that is not the case right now, at least for Tesla. They're talking about a $5 to $10 billion stock buyback next year. They've never really bought back stock before, so that's very interesting and something to continue to know. I don't know if this is just Elon Musk being Elon Musk. It very well may be, but that's definitely something to watch going forward. Other things I would just say on the earnings this morning: Union Pacific is struggling, but that's mainly due to its own issues. It seems like September, the labor union negotiations, they didn't really have much of an impact on UNP itself, on the rails themselves, but they did take some demand away from the rails because a lot of retailers didn't want to tie up their inventory on rail in transit just before the labor unions went on strike. So that took some demand off the rail and onto the road. However, velocity and train velocity has improved markedly over the last couple of weeks. So the stock's down 5% pre-market. It seems a little bit of an overreaction. And you almost want to buy into that dip, although it's tough to buy into any cyclical right now. at this point in the cycle. So we do own a little bit of Union Pacific, and we'll continue to do that. We think it's a good company long term. It's good as part of the portfolio, but we don't want to get too aggressive with it right here. Dow Chemical also reported earnings, and I think it speaks to the theme that overall North America is actually fairly strong and pretty resilient, similar to what we were seeing from IBM. It's Europe that's a big issue right now. Some CEOs that we've talked about, David Solomon at Goldman Sachs, Jeff Bezos even, talking about a need to batten down the hatches in a tweet a couple days ago. But other CEOs are saying that North America actually remains fairly robust. So it's a mixed picture out there. I think that some of the more forward-thinking CEOs are being a little bit more conservative. David Solomon, Jamie Dimon over at JP Morgan, Jeff Bezos. But in terms of actually what's going on right now, I think things are fairly robust.
Breaking news, got a text from Andrew. Liz Truss is out.
Liz Truss is gone. So, man, all-time bad tenure as prime minister. So I think it'll be Richie Sunak. And I think that would be a good move for the UK. I think he has a lot of experience in politics. He was with Boris Johnson for some time. I think you'd have a little bit more continuity there than putting Liz Truss in, who kind of went off the wall a little bit. So, and was not very effective as a leader, clearly. So with that, we will see you tomorrow. We'll close out the week. Have a great day.